What's happened to our banking system? Unless you live under a rock, you've heard some pretty interesting news about some of our nation's top banks that no longer exist either because they filed for bankruptcy or have been sold off to other banks. We want to understand exactly what happened and what was the climate that allowed this to occur. In order to comprehend what happened, we first start off with differentiating between two types of banks that I've talked quite a bit about: commercial banks and investment banks. Commercial banks cater to the needs of everyday Americans. They're banks that you go to when you want a checking account, a savings account, or if you want to take out a loan or a mortgage. Because they have the money of everyday people, they had heavy restrictions on where they could invest that money. Therefore, they took on lower risk than most financial institutions, but they also had lower return. Investment banks serve larger clients. They primarily work with governments and corporations. They help companies merge, trade securities, raise money for governments and corporations through issuing stocks and bonds. And they have higher risk because they're in the business of sort of making money, but because of that, they can potentially also have higher return. Now, the groundwork for many of the provisions that existed in the U.S. financial system dates back to the Great Depression. And what happened was that the financial institutions took on a lot of risk. The stock market tanked and unemployment rose. More importantly, a lot of people who had put their savings in commercial banks lost a lot of their money due to the risks that many of their financial institutions took. The U.S. government recognized that the American financial system needed reorganization. This was when Senator Carter Glass and Congressman Henry Steagall drafted a piece of legislation known as the Glass-Steagall Bill. And it was this bill that set the framework for how American financial service firms worked until recently. The provisions for Glass-Steagall were very simple. What legislators wanted was to make sure that commercial banks kept depositors' money, our checking and savings accounts, essentially safe and protected. And the way they did that was they put a lot of restrictions on them. First, banks had to decide whether they were investment or commercial banks. Commercial banks then had restrictions on the number of securities and stocks and other risky assets they could own. Finally, there were restrictions on commercial banks and investment banks merging. In addition, in 1956, they passed the Bank Holding Act, which said that banks could not underwrite or sell insurance products. The basic gist of these acts was that they created these walls or barriers between financial institutions, and they argued that all three couldn't get involved with each other's types of financial services. But over the decades, Glass-Steagall began losing support. Leaders in business and government were coordinating together to bring about its slow death. You see, Glass-Steagall was seen as this old car model that was outdated and too obsolete to keep the American financial industry on par with the rest of the world. In places such as Europe, they didn't have stringent restrictions among commercial banks, investment banks, and insurance companies being separate. So a lot of people, including former Federal Reserve Chairman Alan Greenspan, started looking for loopholes to get around this legislation. In addition, bank lobbyists had poured about $300 million towards repealing this act. Finally, in 1999, the Glass-Steagall Act of 1933 was repealed and was replaced by Gramm, Leach, Bliley. The basic provisions were that it removed restrictions on the separation of insurance, commercial banks, and investment banks, and it allowed commercial banks, insurance companies, and investment banks to merge. The result was that the wall between these institutions dissolved, and they were allowed to combine together to form general financial services. The result of the dissolution of these restrictions was the emergence of universal banks. Universal banks were banks that could do the services of both commercial and investment banks. Such types of banks were like J.P. Morgan, UBS, and Morgan Stanley. The problem with the emergence of universal banks was that it created excessive financial strain on both commercial and investment banks because they had more competitors. The result was that many banks, particularly investment banks, felt pressured to produce high return. Stressed for quick profits, investment banks therefore started gambling with newer types of financial products and laxer underwriting standards, hence their move towards the riskier mortgage market. It was a direction that would ultimately have many disastrous consequences for some of our nation's top investment banks. To review, repealing Glass-Steagall and replacing it with Gramm, Leach, Bliley had significant effects on changing the financial landscape within the United States. Defenders argue this change was necessary in order to keep American banking on par with the world financial system. Critics contend, however, that this deregulation increased the number of competitors, forcing banks and other financial institutions to take on more risks. Coming up, what went wrong with our regulatory system? Thanks for watching. To learn more or watch more podcasts, visit www.subprimethemusical.wordpress.com.